One of the biggest fears faced by those pursuing financial independence is the possibility that their investments will not grow fast enough to keep up with their spending once retired, and therefore they may run out of money. As such, the idea of being able to live on nothing more than the dividends or interest earned from your investments is an incredibly intriguing one. Today, we're going to be going over the 3 main approaches people have used to enable themselves to retire on dividends alone. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. When you get right down to it, there are 3 common approaches people take to enable themselves to live off their dividends without the need to sell any of the shares of their investments at any given point. The first is to invest in high-yield dividend stocks, mutual funds, or ETFs. The second is to invest in companies with a history of paying and raising their dividends over time. This is often known as dividend growth investing. And the third is to simply invest in a typical stock or fund that pays normal dividends and live off of that. Each of these approaches have their own pros and cons. Let's go over each individually, starting with high-yield dividend stocks. Investing in high-yield dividend stocks can be both incredibly exciting and lucrative, but also potentially very risky depending on how exactly you go about doing it. The primary benefit to going with this approach relative to the other 2 is the sheer amount of income that can be generated for yourself even with relatively small amounts of money. The high-yield dividend space can be invested in through individual companies that happen to be paying a high yield, or through mutual funds and ETFs that aggregate a bunch of those types of companies, leading to a higher than average yield compared to most other funds. The riskier of the 2 options is of course to invest in companies individually, but the rewards can be pretty great. As of this writing anyway, in early June 2021, some of the highest dividend-paying stocks show yields into the double digits. Just some examples include USA Compression Partners at over 13%, Icahn Enterprises at about 14.5%, Not Offshore Partners at nearly 11%, and Natural Health Trends Corp. At just over 10.5%. Now, even if these companies' share prices remain flat, getting double-digit returns is pretty darn good. Hypothetically, if you invested in those companies and managed to earn those types of yields, you could retire very quickly. This is because your safe withdrawal rate would be at least in the double digits, since at least in theory, you don't care about what happens to the share price of the investment so long as those dividends keep coming in. So if for some reason you actually had your entire nest egg invested in a company that's paying a 14.5% dividend like Icahn Enterprises is, at least as of this writing, which, mind you, would almost certainly not be a good idea, but again, just for the sake of this hypothetical, we'll go with it, and you wanted to live on around $50,000 a year in retirement, based on that dividend yield, you'd only need a nest egg of around $345,000 to pull that off. And actually, it would probably be even lower than that because, again, at least in theory, you'd be able to sell some of your shares if you had to in order to put food on the table. Compare that to the traditional 4% rule, which states that you need a nest egg that's worth around 25 times your annual expenses in retirement to be considered financially independent. In this case, that would mean you'd need about $1.25 million to cover your $50,000 a year in expenses. So you can see how big of a difference this can make. The downside to this approach is that it's incredibly rare for a company to be able to maintain that kind of level of dividend payout for very long. And if the company announces that they will be lowering their dividend, or sometimes cutting it altogether, the share price can tumble really quickly. Because with most of these extremely high yield companies, investors aren't really investing in the company because they think it's good, they're investing in it for the income that it generates. Once that income comes back down to a more normal, or at least near normal level, the risk-reward trade-off changes. And oftentimes that leads to a sell-off. Hence the risk that I was hinting at earlier. In order to make this approach work to its fullest potential, an investor has to be willing to jump into and out of investments pretty regularly, while hopefully avoiding any backlash in the share price or the dividend income due to missed, cut, or lowered dividends. Now, you don't have to invest in individual companies if you're going with the high-yield approach. Many people simply invest in high-yield dividend mutual funds or ETFs. Sure, they may not reach quite the same extraordinary yields, but you're also going to be quite a bit more diversified than you would have when you were just picking a few individual stocks with those sky-high yields. Some examples of high-yield dividend funds are the Spider High-Yield Dividend ETF, ticker symbol SPYD, and Vanguard's High-Yield Dividend ETF, ticker symbol VYM. As of this writing, the Spider Fund has a yield of 4.66%, and the Vanguard Fund has a yield of 2.82%. Granted, that is quite a step down in terms of yield from the high highest yielding individual stocks, but they do offer some share price appreciation, and both do beat out something like a straight up S&P 500 index fund in terms of yield. For reference, Vanguard's S&P 500 ETF, ticker symbol VOO, currently has a yield of just under 1.4% as of this writing. A second option is to put your money into investments that have a history of consistently paying and raising their dividends. As I said, this is often referred to as dividend growth investing, since the dividends you're getting paid grow over time. And it can work pretty darn well if you stick with it. Just like with the high yield dividend approach, you can either choose to invest in individual companies that meet the criteria, or in funds that aggregate several of those companies. Investing in the companies individually can still pose an elevated risk, but it isn't generally as risky as investing in those individual high yield companies. The reason is because companies that qualify as strong dividend growth investments are usually pretty well established companies, and by definition, they've proven their ability to maintain or even raise that consistent payout over an extended period of time. Dividend growth investments are usually separated into a few different classifications, depending on the size of the company, the liquidity of the stock, and the length of time it's been paying those dividends. Some people do classify things a little bit differently, but the most common way that I've seen them classified is as either challengers, achievers, champions, aristocrats, or kings. Dividend challengers are stocks that have paid a rising dividend for at least 5 consecutive years. Dividend achievers have paid a rising dividend for at least 10 consecutive years. Champions have a streak lasting as long as 25 years. Dividend aristocrats also have a 25-year or more streak, but in addition to that, they meet certain size and liquidity requirements. Namely, it must be listed on the S&P 500 index, have a float-adjusted market cap of at least $3 billion, and have average daily value traded of at least $5 million. So in other words, big blue-chip companies on the S&P 500 that are actively traded and have a long history of paying and raising their dividends. As of this writing, there are some 65 companies that meet all of these criteria, but some companies do get added and subtracted from the list from time to time, so the exact count may differ by the time you're watching this video. Dividend Kings is an even more exclusive club who's paid a consistent, rising dividend for at least 50 years running. According to data tracked by SureDividend.com, there are currently 31 companies that make this list as of this writing. The Dividend Aristocrats are probably the most well-known classification, and it's also the one that actually has an index fund that tracks it in the form of ProShares Noble Fund, ticker symbol NOBL. The main pros to using this approach to retire on dividends alone is that your dividend payout generally rises over time without requiring you to invest in a bunch of troubled companies or fly-by-night stocks that may be incredibly unstable during market turbulence. And respectable levels of income combined with acceptable levels of volatility is a pretty good pairing for a retiree. Relative to the other options we're covering today, the cons to this approach is that it doesn't necessarily offer the same amount of share price appreciation as some other approaches, and it will not usually have as high of a potential income ceiling as the high yield approach would, simply because the yields are lower. For reference, Noble's yield, as of this writing anyway, is roughly 1.93%. The third option is not really anything special dividend-wise, but it is something that some people still do in order to realize its other benefits while still intending to retire on their dividend income alone. And that is, you can simply invest in a broad-based market index fund like the S&P 500, since it also happens to pay dividends. The pros, relative to the other options we're covering today, is that generally speaking there is more upside to the appreciation potential of something like the S&P 500 than there is for already well-established dividend growth investments and or those higher risk, higher yield dividend stocks, whose potentially high reward usually comes in the form of those dividends, not share price appreciation. This may mean that you'll see the value of your nest egg grow a little quicker than you would with a high yield fund or dividend growth approach, though it's by no means guaranteed, as the additional dividend income from those other options, if reinvested, may be enough to overcome the appreciation gap depending on the time frame you're looking at. The downside for most people intending to retire on their dividend income alone is that they'll likely need quite a bit more money in their nest egg to reach their goal with this approach than either of the other two approaches. Again, looking at the dividend yields for these three approaches, we see that the Spider High Yield Fund is around 4.66%. The ProShares Dividend Growth Fund is roughly 1.93%, and the S&P 500 is about 1.40%. That means that on a $50,000 income goal, you'd need around $1.073 million with the high yield fund to cover your expenses, $2.59 million with the dividend growth fund, and $3.571 million with the S&P 500 to be considered financially independent based just off of your dividend income. Now, directly comparing these approaches can be a little tricky since there's so many moving pieces, such as companies getting onto and falling off of the dividend growth lists like the aristocrats, which can very easily lead to survivorship bias if you're not careful when checking historical returns. And then, of course, there's things like the yields that keep changing, sometimes several times a year, sometimes by a significant amount, especially with those high-yield individual companies, and the fact that we just haven't had funds tracking all three of these approaches for very long. But just to get a general idea of how these approaches have performed for the years where we do have funds to follow, I took a look at some Vanguard funds to get a comparison. For the high-yield dividend fund, I used Vanguard's High-Yield Index ETF, ticker symbol VYM. For the Dividend Growth Fund, I used Vanguard's Dividend Appreciation Index, ticker symbol VIG, which tracks the NASDAQ Dividend Achievers Select Index. And for the S&P 500, I used Vanguard's Original Index Fund, ticker symbol VFINX. I didn't end up using ProShares Noble Fund or Vanguard's S&P 500 ETF just because they haven't been around for quite as long. For reference, the Noble Fund was created in 2013 and Vanguard's VOO ETF was created in 2010. The High Yield Dividend Fund was created in late 2006, so the time period that I'm going to be looking at is from late 2006 through May 2021, which is the most recent completed month I have available to me at the time of this writing. This means that we'll be able to see how these approaches handled themselves during the Great Recession of 2007 to 2008, the Great Bull Run of the 2010s, and this most recent downturn we experienced in 2020. Of the three funds, the S&P 500 approach had the strongest overall growth, earning an average return of about 10% per year during this time frame. A $1 million portfolio in late 2006 would have grown to around $3.96 million by mid-2021. The biggest crash was during the Great Recession, of course, when the share price fell by around 52.4% at its worst. Though with dividends, that fall would have been cushioned slightly, falling to just around 51%. During the crash of 2020, it fell by about 20% based on the monthly return data from Yahoo Finance. Of course, we know in reality if we looked at the daily charts, it would have fallen around 30%. But Yahoo Finance's data just takes kind of an average of what happened during the month. Anyway, speaking of dividends, that $1 million original nest egg would have earned nearly $443,000 over the course of this roughly 14.5-year period. On average, that's about $30,300 a year or $2,530 a month. Coming in second in terms of overall returns is the dividend growth approach. It averaged returns of about 9.7% per year during this time frame, meaning that a $1 million portfolio would have grown to around $3.87 million in mid-2021. It also managed to produce superior crash metrics during these years. It fell by only 42.7% during the Great Recession, 41% when dividends are accounted for, and recovered by February 2011. The S&P 500, for reference, didn't make a full recovery until around March 2012. And then it fell by just about 17% in 2020 based on that monthly return data from Yahoo Finance. Its dividends also managed to provide more income during these years compared to the S&P 500 approach, as we would expect. In total, a $1 million original portfolio would have generated around $494,500 in dividend income during this 14.5-year time frame. That's nearly $34,000 a year on average, or roughly $2,825 a month. And placing third in terms of overall returns and stability during these years was the high yield approach. It posted average annualized returns of about 8.4% per year, and fell by about 54.4% during the Great Recession, 51.6% with dividends. It also fell nearly 24% during the downturn of 2020, and it took just as long as the S&P 500 approach to recover from the Great Recession, but took the longest to recover from the downturn of 2020, finally getting its head back above water in December. On the bright side, it did generate more income and dividends than either of the other approaches, and not by a small amount either. It generated just shy of $694,000 in dividend income during this time period. That's just under $48,000 a year, or roughly $3,965 a month. So it had less overall growth and was less tranquil. But for those looking to live just on dividends, it did manage to hold a fairly substantial lead over the other two approaches in that regard. Now, whether this is actually a net positive for those who aren't planning to live purely on their dividends is a bit of a different story. For instance, during this stretch of years, you could have lived on around $61,500 a year using the high yield approach and still had at least $1 million left in your nest egg in mid-2021. Using the S&P 500 approach, you could have lived on a little over $68,000 a year and accomplished the same thing. And using the more stable and, at least during this year's, almost as well earning dividend growth approach, you could have lived on about $72,300 a year. So the high yield approach nets you more dividends, yes, but what it's giving up in terms of share price appreciation, at least during the time frame that we're able to look at, was more of a hindrance than a help for those willing to sell at least some of their shares during retirement. So those are some of the most common strategies people have used to set themselves up for retiring on their dividends alone. There's the high yield approach, which will likely produce the strongest dividend income and thus allow you to cover your expenses in retirement with less money overall, though it may be giving up some returns in the form of share price appreciation in order to do it. Then there's the slow but steady approach of investing in companies that have a long history of paying and raising their dividends. It may require a larger nest egg to fully cover your expenses with dividend income on its own, but it also may be more stable during market turbulence while not giving up quite as much of those share price appreciation-based returns as the high yield approach would. And then there's this standard index fund approach, where you aren't selecting the investments for any dividend-centric purpose per se, but are still happy to take whatever dividends are given out along the way. This approach will likely require the largest overall nest egg of the three if the goal is to retire purely on dividend income alone, but you may be able to make up for some of that with its higher growth potential, especially if you're willing and able to continue investing as much, if not more, than you normally would during market downturns. Since this approach may not be quite as stable as the dividend growth approach, you may get more opportunities to buy when the market is on sale. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.